wasn't on the right one. Yeah, is the LinkedIn still working on this one? Or the LinkedIn comments?
Good afternoon, everybody. Welcome to Purelite Ventures Presents. We are excited today to talk about venture collaborations within our ecosystem, which is our healthcare ecosystem. And what we're going to be doing today is introducing you to Spencer Tyson. But before I do this, I'm going to introduce you to Emmanuel. Emmanuel is a fellow at Purelite Ventures. So if you have a deck that you would like to share with us and you'd like us to review, please send it to him. He will take a look at it, and he's put his email at the bottom of the screen. So please grab that, and you can, of course, use that and email him. And without further ado, I would like to introduce you to Spencer Tyson. Now, Spencer is a corporate finance veteran and an early stage fintech investor. He brings over a decade of experience from institutions like Guggenheim Partners and State Street. He's also worked with fintech startups such as Revere. Now, Spencer works as a VC at Fiat Ventures. Now, Fiat Ventures is an early stage fintech investor firm, and it is located in San Francisco. Welcome, Spencer. We are so happy to have you here with us today.
Thank you for having me, and I'm happy to be here.
I would love it if you'd talk a little bit about yourself. I know that I've given a brief introduction, but at the same time, I would love for the audience to hear a little bit more from you.
Yeah. So as previously mentioned, I'm all things finance and fintech. So I had, as you'll hear a lot of people say, especially in early stage venture, sort of a non-traditional route into my role. I started off in corporate finance, but I didn't come from banking or consulting, where you'd normally see growth stage investors on the deal side. I came more so from operations, and what that did, it gave me a unique viewpoint because I used a lot of the technology that a lot of the asset managers and investment managers were using. And needless to say, it was very outdated. And so you could see sort of from the ground up the technology that was kind of coming through. I moved up to the Bay Area probably around 2019, looking to get into early stage venture. And at that point, it was still pretty tough. But I had a mentor tell me, if you want to be an early stage investor, you have to work at an early stage company, because at the growth stage, while you can run typical financial analysis on a company that's been making predictable revenue, at the early stage, it's more about building the company up. And so there's no way to learn that other than just to do it. So I joined a company called Revere VC. Revere did it performed due diligence on VC funds themselves, and our clients were the limited partners, so family offices, investment advisors, high net worths, endowments, foundations, etc. We were venture backed. We raised 3 rounds of capital. I was employee number 3. We were there, or was there from inception all the way up to Series A. And during that time, I learned a lot about sort of the early founder journey, from early hires to raising capital to product market fit to product iteration, building out a network, et cetera, et cetera. And during that time, I ran into Marcos, Drew, and Alex, the team at Fiat, and having met several hundred VC firms, I thought they had one of the most unique angles in the game, especially for an emerging fund manager. So I joined Fiat probably about 1.5 years ago. Fiat is a multi-pronged approach to supporting founders. So Fiat started with a growth marketing agency because the partners came from early growth roles at companies like Chime, Ripple, SoFi, Steady, and had a lot of success. And so what they did was they wanted to make a full stack outsourced growth marketing firm to support companies from early all the way to IPO. After running that successfully for several years, they got the rights to invest in a lot of their companies, which then gave birth to Fiat Ventures. And now Fiat is about a 300-person organization. There's about 6 of us that work on the investment side. There's about 35 that work on the growth side, sitting in with Series A all the way to public companies. and then about 250 advisors across the country who are either consultants or executives at other financial services firms or fintech firms. And we leverage this massive network across the country to support our founders, whether it be hiring, outsourced CFO services, like I said, growth marketing, or investment within our network. So it's a multi-pronged sort of institution. We're wrapping up on our second fund, and we like to invest in pre-seed and seed enterprise fintech. Generally checks between 750 up to $1.5 million, and we'll generally lead, take board seats, and use our community to help the companies grow.
That's fantastic. And so, based on all you have talked about, you gravitated towards fintech as your vertical. Can you speak a little bit more about why fintech for you, and what makes you so excited about diving into that space every morning?
It became a natural fit. So as you mentioned earlier, we both ran through the fellowship at VU Partners, and I was just trying to get into venture. I didn't necessarily know what sector at the time, and the sector that was assigned to our group was alternative foods. So I looked a lot at like cultivated meat. Excuse me. I looked a lot at different sources and performed different research projects and built out a network and things like that. And it was interesting. But it wasn't necessarily my passion. I think what put me back on the path of fintech was working at Revere, was working at a financial services firm, and seeing, hey, you know what, as we look at strategic partnerships, as we look at our client base, as we look at the types of companies we're trying to sell to, it just became a natural fit, because I had a network, having worked in finance for so long, and that industry expertise made a lot of things secondhand, where I could come in with experience and say, hey, you know what, this is a way that we should try. This is a way that we can iterate. This is a problem that needs to be solved. So I mean, it got to a point where, VC has always had these buzzy topics, from Web3 to crypto to AI. And I didn't want to be sort of a ride the wave kind of person, because I wanted to have value. And the best way that I have value, the best way that I have, information that I can offer is working within the financial services. It's what I studied in undergrad. It's what I studied in business school. It's where I've worked for over a decade. It comes natural. My wife tells me to shut up half the time because I talk too much about finance. So it just became a natural fit, not without trial and error, not without exploring a little bit. But I mean, I think the cool thing about fintech is that it touches everything.
Yeah.
We were chatting yesterday. One of the things our partners Marcos likes to say is, even from the early days of human beings, when we shifted from being hunter-gatherers to the barter system to the payment system, we had to find a way to exchange some sort of good or some sort of currency for goods and services, and that started off with payments. And so, whether now tying into the theme of collaborations, whether it be healthcare, whether it be crypto, whether it be legal tech, whether it be industrials, you're going to have to find a way to pay for stuff. And so fintech finds its way to nestle into almost every category. And so we look at a lot of adjacent categories that have some sort of theme that fintech will touch.
I would love for you to speak a little bit more about that in terms of healthcare, because we, of course, as you mentioned, and as I know full well, there are insurance companies, there are payers, payees, patients. There are so many things that have to happen in the healthcare system. And even for different startups that are approaching healthcare, through different angles and channels, they still have to engage in commerce, and they still have to engage in paying their vendors and engage in collecting monies from people who they work with. So I would love to speak a little bit more about that, because increasingly I've been seeing events where you have healthcare and fintech together. They're actually catering to both of those in particular. So I would just love to delve into that a little bit more.
Yeah, I think it all really starts off with, if you look at the current structure of a lot of different industries, but we'll talk about healthcare. The payment system is really outdated. Whether that's the way that you pay for insurance, whether that's the way that you access Medicare, Medicaid, whether that's the way that dentists charge, insurance companies. A lot of that is very manual. A lot of that is very outdated. And these are industries that are making tens of billions, if not hundreds of billions of dollars. So they have the capital to change. They've just not really had much of an incentive. Now, as legislation shifts around sort of who gets access to what, now as you start to have a lot more medical practitioners shift from a large corporate setting to their own boutique setting, and maybe they don't have the capital for headcount for like a CFO service or whatever the case may be. Now people have a need to innovate. And so that's where you see a lot of the tailwinds, as we say in finance, the things that are sort of driving the market forward. And what we're looking to do is we're looking to find operations that, it could be very, very boring. It could be, something as not necessarily sort of out of mind, but something as simple as like an HSA account that a lot of people don't know that they have access to. So what we're looking to do is we're looking to find people who have experience and have pain within that payment structure, and who has the most creative solution to sort of innovate the industry that allows the market to move along with that tailwind.
That's fantastic. And I'm in agreement with that. We're definitely looking for the same types of solutions that can move all this forward. Now, I'm also curious about what a founder should think of when they approach your fund in terms of getting their next check or their next funding check, if they're the right fit for you, and how should they think about that?
So I'd say two things. One, it's a long-term relationship game. And two, there are so many VCs at the early stages, especially, that are sector specific. So I'll start off with the sector specific. We invest mostly in fintech and fintech adjacent. So while we do look at things like payments and insurance within healthcare, we won't do any biotech deals. So as you're looking to reach out to a VC, make sure that your company aligns with their thesis. And a lot of that is just because, we're a small fund, we're an emerging fund manager. And so in order to prove that we deserve limited partner dollars, we have to show that we're a subject matter expert in one niche thing. As we grow larger, obviously there's room to become more generalist, but if you're an early stage company looking to approach an emerging fund manager, especially those that are pre-seed and seed investors, you've got to make sure that your sector aligns, the thesis aligns, all of that. But also understanding that it's a long-term game. It is rare that we see a company pitch us and we're immediately like, let's roll, let's take them to committee. I'd say a lot of the companies that we invest in will have a several months long relationship with. And so once you do pitch a VC, don't take a no as a no forever. A no is just, hey, you know what? I have 500 companies a year in my inbox, and a lot of them are kind of around the same place, and some of them have amazing traction and amazing connections. It's not to say that you're not going to be a very successful company. I just want to see you hit some of these key milestones that keep you competitive with a lot of the other companies that are pitching me, because I have a responsibility to my investors to make sure I'm giving them the best look as well. But what you can do, even if you do get that no, is add all of the investors you speak with to your quarterly or monthly updates. I mean, there's plenty of times, at least 2-3 times a month, where I'll hit a founder back up and say, hey, you know what? I've seen your monthly updates. we first met, you were at 75,000 in annual revenue, and now you're north of half a mil. Like, let's restart that discussion.
Yeah.
You followed through. You were somebody who's been persistent. I've had a chance to get to know you a little bit. Maybe we've kind of checked in on a monthly or quarterly basis. So it's very much about building that relationship. So assume that even though it's a no, if it's not if it is a sector fit, keep them in the loop. Because a lot of times those are the companies that we end up taking to committee.
It's very true. Things can change. Things can very much change in an instant, and keeping that relationship going means a lot, because it means also that that founder is dedicated to what they're doing, that they're not giving up. And I remember I was watching a program, and I think her name is Cochran. She's a real estate agent, and she's also on Shark Tank. And what she's looking for are jack-in-the-box people, as she described it. Like, when you close it, they just pop right back up, And so, as VCs, we're looking for that too. Thank you for that.
Absolutely.
That answer. And the next thing I would want to talk about, and you touched about it a little bit when you spoke about the history of Fiat, but how do you work alongside go-to-market and commercialization initiatives?
Yeah, I mean, taking a step back, I think everybody is looking for good strategic investors. Obviously, capital is great, but early on, it's all about sort of like, what can you do to help the company grow? And there's really kind of 3 or 4 things. How do you help us secure follow-on capital? How do you help us secure our first few clients so that we can kind of start building product market fit? And then how do we help go to market, scale out, and commercialize this effort? And then lastly, how do you help hire, right? Vast majority of pre-seed and seed budgets are generally to hiring staff. So Fiat specifically, because we have a team of 35 growth marketing experts across the country, what we can do is we can plug in right alongside your company. If it's an early stage company, we'll work right alongside the founder and help, build a strategy and iterate. We don't just sort of build a strategy, hand off a packet on your desk and say, good luck. We'll iterate alongside with you because we have the team and the time to do that. And as you get into the growth stage, we'll work alongside your sales team in the same capacity. The biggest thing there is that we're kind of plugged in everywhere within fintech, and growing within other industries. And so what we're trying to do is help you develop the right marketing strategy, get in touch with the right people, and help you see that all the way through to commercialization.
Fantastic. So basically, very much like Purelite Ventures, the idea is to work with portfolio companies all the way up to exit or IPO.
And I think another thing that is often overlooked that we also help with is we've got a massive talent network. Like I said, we've got 250 plus vetted advisors who are ready to plug in at any time. We've got an outsourced CFO service so that the founder can focus on, capturing those founder-led sales and doesn't have to worry about being in a spreadsheet. So a lot of these things kind of take work off the founder's hands so that they can really focus on building the company.
Like that. And moving on to something that's a little bit broader, but of course you can make it as granular as you please. How do you approach geopolitical issues based on your territory and based on what you do at Fiat as a fintech VC firm?
Yeah. So and you made a great point, not to get super broad, because one thing that I generally don't love is there's a lot of think boys within VC who are out of nowhere macroeconomists. But what I can say is I like to focus on sort of the flow of capital, right? And what we're seeing now in the markets is sort of a reemergence of venture at a slow pace. Back in 2021, I think there was some $300+ billion deployed in venture. There were 100+ IPOs. I don't know if that includes SPACs as well, but that definitely exacerbated it. And on a typical year, you'll only see 30 to 40 companies IPO. And after that boom, there's kind of been a bust for the past couple of years. And so a lot of our investors from the venture side, didn't receive any liquidity. And because they didn't get any liquidity, they weren't able to reinvest in new funds. And that didn't allow us to invest in new companies. So now we're at a point, especially within fintech, where you hear news of companies like Klarna and Chime and Circle, potentially going public this year. What that does is not only for some of their early and growth investors, give them some liquidity so that they can recycle back into the industry, but some of the early employees are able to get a good kick on their stock owning or stock ownership. And a lot of emerging venture funds, they get their money from high net worths and people from, the industry that are like, hey, I want to circle my money back into early stage fintech. One thing that I've kind of learned about the emerging manager circle is that a lot of our LPs are investing in our funds for access to companies. They're off kind of doing whatever it is they do, whether they're a family office and they have several other assets, or they're just high net worth and they just want to enjoy their money and be rich. They're using us as like a vetted de-risking layer to access early stage companies so that they can hit right at that J curve. So what we need to do is show them that we can give the capital back. And unfortunately, venture is a long lockup period. But, as liquidity starts to pour back into the markets, we can invest in more companies and restart that cycle.
Yeah, I feel that's very interesting. Somebody who doesn't really understand venture completely asked me about the stock market and what that means. And I said, well, it does mean something, but in terms of what I do for a living, I'm looking at companies pre-IPO, right? I'm looking for value before it even gets on the radar of somebody who's buying stocks. And that gives an investor, an LP, a great advantage. And you mentioned that J curve. And that's what we offer as emerging managers, an opportunity to get into this type of capital market at a point where, should the stars align correctly, the returns can be phenomenal. So,
absolutely.
Yes. Yeah. So the next thing I would like to ask you about is the life cycle of a startup. Because, many startups will come to you. Maybe they are pre-seed, but maybe they're not ready for you yet. When should they start looking to speaking with you based on their life cycle, based on their timelines, based on what they've accomplished? Or is it a combination of those kinds of things?
Honestly, it's because it's a relationship game, really never too early. I mean, it could be as soon as, hey, I'm working at this large corporation or working at another startup, and I see a hole, I see a problem that's worth solving, and I want to iterate, I want to do something about it. If you start the conversation there, happy to be supportive, happy to entertain that conversation, because what it does is it builds rapport, it builds trust. We invest in companies generally under $15 to $20 million in valuation. So I wouldn't necessarily wait too long to start that conversation. Again, understanding that you're not pitching for an immediate yes. I mean, it can happen, and it does happen in some rare occasions, but start that conversation early. And because we have such a wide range of advisors and people that can help and plug in, we can help connect you to the right people. Whether it be, hey, you know what, I've started this and I need connection to some angels, or I need help with product iteration, or can you connect me to this one company that would be a great enterprise customer, whatever the case may be. It's never too early to start that discussion. And then you're on our radar. And then you build rapport with us. And then you have that chance to show us that you can hit milestones, so that when you're finally ready to raise that pre-seed or seed round, we know you. You know, we've had that conversation. We've built that.
Yeah.
It's people do business with people that they like. And that's kind of always been the motto, at least out in the States. And so start that relationship as soon as you can.
Yeah, that's a good answer for that, and I agree with that. And we were talking a little bit about LPs, but I would like to hone in on exactly what LPs gain from relationships with emerging managers and investing in startups. And I would just love some of your feedback on what you think about that.
So there are several different types of LPs that have several types of agendas. So, for example, a high net worth individual generally is someone who has, worked at a startup or been a founder and exited. And so they've got a conviction behind this sector of startups in general. And so they generally will pour a good chunk of their assets back into the startup landscape, either because that's their DNA and that's what they know. There might be an addiction to risk. Or they found out a way to sort of spread the check around and de-risk it. There's also institutional limited partners like endowments, foundations, and pension funds. And a lot of times they have different mandates for different asset classes. So pretty heavy on public equities, public credit, and they'll have a sleeve for private equity. You've seen sort of like the Harvards and the Baylors of the world really the Yales and the Baylors of the world really make a killing on private equity. And so they'll say, hey, this is a sleeve. I'm comfortable with the long lockup, and I'm looking for fund returns from the fund managers. Then there are family offices who oftentimes they want to invest in the hottest startups before everybody else does. And so they'll invest in emerging fund managers just because, like we were talking about earlier, we are the best de-risking strategy for them to find companies before the J curve. Like, they're not trying to invest in Brex at a 200x multiple. They're trying to invest in a company that you haven't heard of yet that'll become the next Brex. And then lastly, there are corporates. Corporates, I'm not going to say that they don't care about returns. Obviously, everybody cares about returns to a certain extent, but they're more so worried about corporate innovation because corporate development will spend hundreds of millions, if not billions of dollars, like Google acquiring Wiz for $8 billion in corp dev to grab a consumer segment and open up their market share. But sometimes, if you can access a company for, $5-10 million off of your balance sheet and integrate them early, that becomes an opportunity as well. I've recently been speaking with a lot of bankers and people who work in corporate development, and a lot of that strategic acquisition happens at the Series A, Series B. And so they want to see these companies grow from pre-seed and seed, and emerging managers is their best way to do it. If I think about Fiat's LP base, we're kind of a combination. We're not quite at the institutional level just yet because we're still an emerging fund manager, but a lot of them are high net worths. A lot of them are strategics, like Reinsurance Group of America, like Mass Mutual, who are really using us as like a corporate innovation arm to vet companies that they can integrate within their own tech stack.
Very interesting. Thank you. And I do agree with that, especially the de-risking part, because we do a lot of due diligence. And as we were talking about earlier, we are always working to be subject matter experts in our particular verticals. So that being the case, we do understand that it can be a risky game, but the rewards are very great, and we do that de-risking on a daily basis. So my next question is, what trends in VC have caught your eye recently, Spencer?
I think it has been interesting to see the different strategies that people are deploying under, um, and not kind of following, buzzy, trendy topics, right? One thing that I can definitely appreciate is automation. Everybody talks about AI this, AI this, but a lot of VC firms are keeping pretty lean and not hiring a whole bunch of staff members. One, because with most emerging fund managers being under $50 million, that's maybe a million or so in management fees a year, which after paying a salary, paying for office space, paying for expenses, et cetera, you really can't hire too many people. And so using no code and low code applications to kind of vibe code your way through things, putting together a community of sort of outsourced advisors or workers or venture partners. You'd be surprised at how scrappy a lot of emerging fund managers do really have to be in order to build up that practice. One thing that we have found that has kind of caught a little bit of fire is in-person events. So we are throwing probably about 50 events this year. And what that does is, we'll say on our deck, hey, we have 300 people in our ecosystem. But if you come to one of our events and you see, 25, 30 advisors in New Jersey or Miami or Chicago or Cleveland, and they all show up supporting Fiat, the investors can really say, and the founders can really say, wow, you do really have a coast to coast reach. So I'm seeing a lot of in-person events really pick up within venture. And then I think at the early stages, you're starting to see a return to discipline in terms of valuations. One thing that you heard a lot a few years ago is, hey, yeah, we usually write this size check and we usually look for this amount of ownership, but if it's the next Google, we'll make an exception. Well, a lot of times chasing valuations has gotten people in trouble. And even if you do get an exit, you've spent so much money trying to keep your pro rata. It's a flat exit, and you're in this game for multiples, especially with the long lockup period. And so you're starting to see, in terms of portfolio construction, VCs are saying, hey, you know what? If it's above this valuation, it's just not for me. And that's not necessarily a knock. It's just, hey, I sold a product to my limited partners, and my product is a portfolio of this many companies at this valuation.
Yeah.
And so the more that I break that construction, the more that I'm breaking the product that I sold to my customer. And so trickling down to the founder now, that's something to be cognizant of. I think it's a case by case on sort of what valuation you go off of. But I will say from experience at a startup, if you chase the valuation game, you're getting the same money regardless, right? You're raising $1 million, $2 million, $3 million. You're getting the same money regardless. But if you try to jack up that valuation, all that does is now put pressure on you to justify it with a revenue multiple. And we're paying a lot more attention to that because capital is a lot harder to come by, and we've got to be much more judicious with our check sizes. So a lot of different things sort of within the venture industry, but it's shifting. The talent that VCs pull in is shifting. The way that we deploy capital is shifting. The way that we build out our own infrastructure is shifting. It's an interesting time to be in venture. Definitely is an interesting time, but while we're forced to be scrappy, just like startups, you'll start to see a lot of real gems come out of this time period.
I find that very interesting because people don't think of venture capitalists as founders. But it's very touch and go there, right? Because we are, but we do support startups as well. So
there's several things in common, right? You've got to go fundraise, you've got to pitch your expertise, you've got to pitch your network, you've got to pitch a strategy. A a lot of especially emerging VCs, it's not just like, hey, I sit on the cap table and I go drive my Tesla home. It's like, no, it's a lot of these people are same as you, living off of savings accounts and going to fundraise and hearing 99 no's before they hear a yes, and building that relationship with limited partners. And a lot of it is very similar. And hey, we've got to figure out who to hire and what works and what doesn't. And I got to work out of a WeWork for the first 3-4 years of my funds, all the same, all similar kind of aspects. So to that extent, I think that's where the similarities are now. I think a big difference is, once we've secured the fund, our management fees are our management fees. And so that salary is kind of locked in for that 10-year period, where there's a lot more volatility as a founder. You could get a customer, the customer could churn. And so, there's similarities and differences kind of within the whole ecosystem. But yeah, I think there's a lot more similarities than people realize. Yeah.
So I'm also curious about the way that you guys have formulated your team. You talked a little bit about that, trying to find things that work, but to reach your goals. And right now, you guys are an emerging fund, but you're doing extremely well, and you're doing some really big things. So I would just like to hear more about how you guys curated your team.
Well, it started off with growth, and I think that's what's really unique about us, is that we built the engine before the venture firm. And so that was curated by Drew Glover and Alex Harris and their amazing networks. They said, hey, these people are all experts within fintech. These people are the cream of the crop. Let's bring them into our ecosystem and make sure that they can provide value to our company. Then, it started with kind of bringing in some of the partners on the venture side, like Marcos Fernandez. And Marcos is, I think, probably one of the most intelligent and most patient people I've ever met. He's got the temperament for fundraising. He's got the relationship building skills to play the long game with both LPs and founders. And then when we think about adding, other industry veterans such as Rohit or community leaders like Adrian Hunter, we start to say, okay, well, what's working, what's not? Iteration, revamp the product. And what we've found is in-person events do very, very well. So we need somebody who can manage not just corporate sponsorships, but the community of founders and the community of co-investors. And so that's a lot of sort of where I come in and help. Some of our flagship events like our AGMs or some of our fintech summits where we bring together hundreds of the best minds in fintech. I will, spearhead some of those efforts and use a lot of my connections within the corporate finance world to say, hey, you know what? You have a need for founders or LPs or other co-investors, which we have in our network, and we have a need for capital to throw this event. And so, what I do is I pitch them and say, hey, this is almost like shooting fish in a barrel. This is 200 of your ICP right here. And you've got a corporate balance sheet to support it. So, it's really kind of seeing what works and finding people's strengths, bringing them in, and seeing sort of how that leads to both dollars invested, but also companies to help support on the fiat growth side as clients.
Fantastic. It's interesting because we went through this period where nobody was meeting in person, and now we've really ramped up and we've been able to get back to that. And I think it's booming now. People do want to meet with each other, collaborate, handshake, get a feel of the person that they are going to be potentially working with. And so these in-person events are fabulous for that. And I look forward to coming to yours in the near future.
Would love to have you.
Yeah. Do you have a bit of time to mention what you guys are going to be doing in the near future in terms of an event or two?
Yes. So June 17th, we are hosting the Fintech Summit, our first inaugural Fintech Summit in San Francisco. 200 people, vast majority are founders between pre-seed and Series A, several dozen investors, and several dozen corporate executives from companies like Chime and SoFi and Credit Karma and Intuit. And what we're looking to do is not only have fireside chats with industry experts, but have several speed networking opportunities where you're matched with somebody that can give you something that you're looking for. So if you're looking to raise funds, we have investors that are looking for companies to invest in. If you're looking for strategic partnerships, we have other founders that are also looking for strategic partnerships. If you're looking for enterprise customers, we've got large corporate executives who are there looking for startups to partner with and pilot test out their technology. So June 17th, the website is thefintechsummit.com. Tickets are up and running, but we are near full. I think we're like 95% full. So if you want an opportunity to come, check it out, grab your ticket today, and that'll be on June 17th. And we're looking to throw these probably twice a year. So we'll probably have another one with fintech and fintech adjacent industries. So if you are within insure tech or climate tech or payments within healthcare, we'll have another one in November that we'll be announcing right after our Fintech Summit in June.
I'm excited for that one, and you know that.
Absolutely.
The next thing we do have a couple questions that we're gonna ask you in a few moments.
Sure.
But and one of them, just to give you a heads up, has to do with collaborations between healthcare and fintech. But I will let Emmanuel put that on the screen in a couple of moments. But I'm also interested in what roles do market trends and research play in your guidance of startups? There are a lot of opinions out there. There are oftentimes a lot of cooks in the kitchen, but I keep hearing this every day, especially when it comes to social media. Should everybody have a seat at the table? Some would say yes, some would say no. But I also know that it's a fact that if you don't have enough counsel, you will not come to the right answers because you just won't have enough information. So based on that, how do you use market trends? How do you use research to really dive into your own due diligence processes with these startups that you work with?
So in our due diligence process, we look for sort of what we call the 3 T's: team, TAM, and traction. And so market research plays a big role for TAM, the total available market, right? What we don't want is to invest in a company that can capture a significant chunk of the market share and still not get those large multiple exits that we're looking for.
Yeah.
We want a market that's several $1 billion where it has room for multiple players. And then we're going to back the right team, provided that they have a little bit of traction, a little bit of a proof point that they can go capture that market.
Mm-hmm.
So we look into various industries, and it comes from a lot of different places. It comes from co-investors. It comes from founders that we speak with. You'd be surprised at how much you learn about how incumbents work just from talking to founders. Because the first thing you have to understand is, how does this industry work, right? Because I can't tell if it's being innovated if I don't know how it currently works. So you learn about the incumbents, you learn about the current market. You have to do your own research to verify, to say, hey, how much money is being spent within a market like this? And sometimes you've got to instead of just trusting what you hear, go and verify yourself. Trust but verify. So for example, if a wealth management tech company will say, hey, our market is several $1 billion because look at all the AUM of the asset managers we work with. Well, no, really, it's how much money are they spending on this type of technology? And so I've got to go and perform my own research there. In terms of the actual company selection, that's another reason why we have advisors. And so we'll have advisors who are experts in various sectors, and we'll say, hey, is this, this is what we're hearing from a founder, is this legitimate? Whether it's looking at a technical review or a market review. Is the money really flowing like this? Is this causation? Is this correlation? Is this something that we should be paying attention to or looking further into, or is this just kind of buzzy? So market trends definitely play a role, but we have people that we trust within our team, and founders that we trust within our portfolio, to use as a sounding board to make sure and that we can verify a lot of those market claims.
Fantastic. And we have a question for you. So Helene's asked, thank you for your presentation. Do you have any examples of collaborations between fintech and digital health startups?
Yeah, there's a couple of companies that we're running through diligence right now. I'll keep the names out just for now, but I think one really focused on, like I think I mentioned earlier, health savings accounts and helping you maximize the money that you get out of health savings accounts. So not only is that, hey, people are spending all this money on healthcare, but there is a fintech angle to make sure that you maximize your HSA account. And you're incentivized for it, and your employer is incentivized for it. There's also another startup that we're looking at that helps sort of dentists maximize the insurance payments. So, as it stands, whenever somebody goes to the dentist and they use their insurance to pay for it, that payment is sent into a physical lockbox where, there are people who are kind of sorting, and it's a very slow and manual process. And so they're digitizing that process so that they can much more easily invoice insurance companies so that dentists can get paid on time. And this is a really huge step up for especially a lot of the boutique dentists that don't have that heft and that bandwidth. They can run their practice well, digitally. So, there's a lot of opportunities out there. This is something that we've really just started exploring within Fund 2, but definitely excited to kind of explore a lot further.
That's very interesting. I've also heard about different companies who are looking into insurance payments for different diseases or different, how would you call it, operations and medical procedures. But when they look into these medical procedures, there's a big competition about who does these procedures, how much they cost, and where to do them. And so there are companies out there that are actually creating a system where insurers can pick the best and most cost-effective procedures for their patients, rather than just saying, okay, this procedure is $100K and that's what you have to do. There might be somewhere where you can get it for $50K, which is just as good. So there are other things like that happening in healthcare and fintech as well.
Absolutely.
Yeah. So I'm not sure if we have any other comments or questions, but we do have people who have definitely appreciated you and have been really happy to meet you, Spencer.
Absolutely. I see another question. With AI booming nowadays, how do you see AI influence in fintech? So I'd say something that I see a lot is automation of research and modeling. I'm seeing a ton of startups that can automate discounted cash flow modeling, leverage buyout modeling, credit research, a lot of the manual tasks that analysts generally would spend 12 to 14 hours a day doing. A lot of that is something that you can automate using a large language model. Now, granted, with a lot of things like that within fintech, my personal opinion is that there's still going to need to be someone who checks it at the end. I don't think it's just kind of a set it and forget it. So I think this is something that handles a lot of block and tackle work. And as much as I'd like to say it's not going to replace a job, companies are always going to find a way to reduce headcount. So what I think the realistic sort of immediate near term of something like that is, they're going to give this technology to the analysts, have them use it, have them, build the reports, save them a lot of time, and free up and say, hey, go find other value. Even kind of tying it into legal tech. My sister is an attorney. She's a secure derivatives attorney or a paralegal while she's still in law school. And she's like the designated Harvey user at her firm. So I think there's going to be, a huge application there, specifically within traditional finance. There's also risk management and KYC policies. So, there's entire teams that are dedicated to managing exposure to all of your counterparties. And then you've got to do diligence on each of the counterparties, making sure, if a securities violation comes up, you're on top of it, making sure that as you go into an agreement with the new client, that they're not on, a list of restricted clients. And so, AI and automation continuously feeding and scraping the web, that's going to be a huge application because that's huge for registered broker dealers. That's huge for registered investment advisors, things like that. I think a lot of it is to do with automation. And as you look at companies, especially early on, they may not have to grow headcount as fast, and they might be able to use AI to hire and do a lot of the mundane tasks. And then the last thing is the rise of vibe coding and platforms like Lovable, where a friend of mine is the director of engineering at MLB, and he's like, hey, well, before the engineering team would get a request from the product manager, and then we'd have to build the spec, test the spec out, build the product. Now we can have the product manager in a no-code environment build the spec, and then I can just take it and I can go the last mile. And now that allows me to build out so many more projects. And that's not just fintech, that's everywhere. So there's a lot of different applications for AI that aren't just sort of buzzy, but that actually can save time and allow you to be a little bit more creative.
I feel it's very interesting when you look at AI. I've never had any type of innovation that I've had on my desktop give me less work to do, in the sense that there wasn't something else that I could use my time for. Right? So it's always either made me more available. It's either given me the opportunity to do a task faster, so the expectations have become higher than they were before. So it's very interesting. Like when I look at AI, I appreciate it because it moves things a lot quicker. But I do see that, especially in our fields, we will begin to see more and more. It's almost like with molecular genetics, there's a question out there. Do we have more people with cancer because we have more sensitive instruments at testing? Or do we really have more patients with cancer? See, so there are like all these different questions that arise when you have better systems in place. So I'm looking forward to the things that AI will bring for both fintech and healthcare. I think it's going to be exciting, and I'm definitely excited about being part of it. I have a question about one specific outcome for your clients that you would love to see happen. If you want to have two of them, that's fine too. I'm open and receptive to two of them, but one is just fine.
I'd say an outcome that we'd really want is to find product market fit. I think that's such a high hurdle, and that's such a difficult thing to do, where you understand what your customer acquisition cost is and you understand the lifetime value as a customer, and you can say, hey, this is how much I need to put in order to get this output. Because then you have a running business, and then you don't have to worry so much about fundraising and things like that. You can focus on the business. When times get tough, you can focus on the business. It's a very, very difficult hurdle to overcome, but if I could wish that on all of our clients, I'd love for them to all reach product market fit in some way, shape, or form.
That's very interesting, because there are so many things out there where people might see that they have a particular need, but it's not the need of enough people to create a TAM, SAM, or SOM that is venture investable. It's not that it's not important, but venture is a certain type of structure where it has to be viable, and it has to be something that many people want to use or pay for. More specifically, it's a big enough problem for them that they're willing to part with their dollars to have that solution. And I'm wondering, is there a way that it can be more easily communicated, and that founders can grasp onto that? And also, for me as a VC, that's also something too. Because, I look at things and I think, oh, that's a great idea. However, after due diligence, sometimes I have to pull back a little bit.
That's the grand question. And if I had the answer to it, then this industry would be so much easier. It's different for different people, and it's different for different circumstances, whether you're selling to consumers, whether you're selling to enterprises, what the sales cycle looks like. Are you going to lead product development via client feedback, or are you going to try to be that visionary? It works differently for different people, and so I can't in good faith give sort of a one size fits all answer. That's probably part of the biggest struggle, especially as an early stage company, is what do you need to do to achieve that fit? It's definitely finding customer concentration, but I mean that's such a vague term. I mean, everybody would love to sell the same thing to everybody. I'd say one thing that I wouldn't waste my time on is trying to build a bespoke solution for more than 2 or 3 different types of clients, because then it just becomes kind of a waste of resources, and you don't really have any fit. That just kind of becomes a service business. So if you want to stay within that venture scale, finding that customer concentration and saying, hey, you know what commonalities do all of these people have in their pain? And if there is no commonality, it may be time to consider a pivot.
I love that. It seems like there's another question for you. We might have a minute or two to answer that. Does fintech innovations follow the same trend as health tech innovations that have to prove their technology in the U.S. markets prior to commercialization in other markets?
You see kind of similar followings. So, there's like M-Pesa and Chipper Cash, which are out in Africa. There's like PPay, which is out in Cambodia, which all kind of, mirror Venmo. But, you also have applications like WeChat, which is, WhatsApp on steroids, where you can not only communicate, you can pay and all that kind of stuff that came out of Asia. So I wouldn't necessarily say it has to start in the US market before expanding into other markets. We can take plenty of tips from other markets and bring them in here, or they can just do well in those markets. Every country is different and has different dynamics and has different problems that need to be solved. So, it could be where, looking for payments within healthcare is a problem in the US, where in somewhere where they have universal basic healthcare, it's not an issue. So it may not have to follow that trend. So it really depends. There's almost 200 sovereign nations, and they all have 200 different problems that need to be solved. So
Yeah.
I'll answer that with a not necessarily. There's cases for and cases against.
Mm. Well, that brings us to the end of our discussion, Spencer. Thank you so much for spending this time with us at Purelite Ventures Presents, more specifically with me and Emmanuel here. We've enjoyed all of your discussion, your comments, and your ideas. And we are looking forward to partnering with you, attending your events. And also, we are going to share your event on our page as well. And we are just so excited to share this webinar with people who are involved with Purelite Ventures, because I know they're going to get so much value out of it. And I know that they are going to be excited to have you as part of their network as well.
Of course. Thank you so much for having me. This was awesome. Appreciate your guys' support and looking forward to continuing to partner.
Sounds fantastic. Bye-bye.
Take care.